Good morning, hunters. Welcome to the Daily Hunt for Multibaggers on this Wednesday, January 14th, 2026.
That's right, Ethan. We've just wrapped up analyzing a pretty active day of data from yesterday, January 13th.
Yeah, a lot of buzz out there, Brooke. We saw discussions around over 800 posts, flagging 19 different stocks for our attention.
And it's a real mixed bag sentiment-wise. While there's definite optimism for some high-growth plays, many are also flashing some serious risk signals that we need to dive into.
Absolutely. Let's get right into it. First up today, we've got JP Morgan Chase & Co., JPM. Our AI-generated insights show some fundamentally positive signs here, despite one user's pessimistic personal trade. JPM just reported strong Q4 2025 earnings, beating estimates thanks to solid trading and net interest income. Piper Sandler, they even raised their price target.
Well, Ethan, while the earnings beat is good, let's not overlook the weak investment banking segment mentioned. And that one poster, despite buying calls, expressed, "Hope we lose the remaining 50," which is hardly a vote of confidence. The user comments really focused on his reckless trading, not JPM's actual fundamentals. Though I do see the insider buying, over 10,000 shares purchased in the last 6 months, which is a strong signal. The PE of 15.5 isn't extreme for a company with a 1.85% dividend yield and robust profit margins.
Exactly. Those insiders know something. It's a blue-chip financial institution, and the historical performance shows a general upward trend. We previously had no rating on JPM. Given the strong profitability, insider confidence, and analyst upgrades, I think it's a solid buy today.
For JPM, I'm with you on a buy. The key PIs, especially insider buying and strong profitability, outweigh that isolated user's personal sentiment.
Next, let's look at CME Group Inc., CME. We've had a stay-away rating on CME back on November 30th, 2025. This time around, we're seeing strong operational efficiency with incredibly high net and operating margins. They're even launching new 100-ounce silver futures contracts, expanding their market presence.
Hold on, Ethan. The user sentiment is almost entirely negative, portraying CME as an antagonist and manipulator in the silver market, especially with their margin rule changes. And the key PIs, while showing high margins, also reveal stagnant, actually negative revenue growth at negative 0.03%. That's a huge red flag for a company with a PE of 26, which suggests a premium valuation, not to mention a very high debt-to-equity ratio of over 13. Insider buying is modest, but it doesn't offset these fundamental risks.
I see your point on the user sentiment and the debt, but those margin rules could be risk management, right? And new products could boost revenue.
Potentially, but it's speculative. The current numbers tell a story of high leverage and no top-line growth at a premium price. My KPI analysis suggests the stock might be overvalued. So for CME, my verdict remains stay away.
Yeah, I'll agree with you, Brooke. Given the debt and negative revenue growth, it's a stay away. All right, let's turn our attention to NVDA Corporation, NVDA. Now, the social media post for NVDA was actually about an app, so no direct user sentiment to gauge there. But looking at the company, they're poised to lead in AI, defense, and quantum investments for 2026. The revenue growth is exceptional at over 62%, and net profit margins are above 50%. That's incredible.
Ethan, those are indeed impressive operational numbers, but the PE ratio is sitting at a whopping 45.8, indicating extremely high growth expectations are already priced in. The debt to equity is also very high at 9.1, and the beta is over 2.3, meaning extreme volatility. We've seen insider selling of over 3 million shares in the last 6 months, and let's not forget the major downside catalyst warnings and geopolitical risks with China chip sales. Our previous ratings have been quite mixed, with a stay away as recently as January 9th.
You're right, Brooke. Those are significant risks. It's a high-flying stock, but with that comes heightened caution.
Exactly. For NVDA, despite the phenomenal tech, the valuation and risk profile make it a stay away for now.
Up next, we have Carvana Co., CVNA. This one's interesting, the user post was about a huge loss from shorting CVNA. The comments are full of people acknowledging CVNA's massive rally, expressing regret for missing out. It's up hugely from its 52-week low. They were just upgraded to buy by some analysts and included in the S&P 500. This is pure momentum.
Momentum can be a steamroller, Ethan, but this steamroller has a turbocharger on the back of it and it's running on fumes. The PE ratio is over 106. That's just astronomical. The debt to equity is an alarming 192.4 and the beta is an extreme 3.55. Net profit margins are razor thin, and we're seeing insider selling outpacing buying. The user sentiment reflects past gains, but the current financial picture is highly speculative. Our most recent ratings have consistently been stay away.
Wow, those are some stark numbers, Brooke. That
PE, it says it all. For CVNA, it's a definite stay away. The risks are simply too high for this valuation. Let's discuss Figma, Inc., FIG.
The community sentiment here is predominantly bearish, fearing an insider lockup expiration and an insider dump that could send the stock to $15. However, my data shows something different. Over the last 6 months, insiders have actually been net buyers of 338 million shares, which is a massive vote of confidence. RBC Capital even has a positive outlook for FIG as an AI-ready software firm.
Ethan, that insider buying is a fascinating counter-narrative to the user chatter, but let's not ignore the fundamental problems here. FIG is deeply unprofitable, with negative net profit, EPS, and operating margins. A price-to-book ratio of nearly 12 for an unprofitable company, plus a high debt-to-equity of 4.41, the stock is trading near its 52-week low, which fits the user's perception of it being hella overvalued at IPO. That insider buying suggests a long-term belief, but for now, the numbers are very challenging.
So despite the insider confidence, the current profitability issues are too significant?
Precisely. The core business isn't generating profit. For FIG, it's a stay away.
Now for Advanced Micro Devices, AMD. What a day for AMD. We saw multiple posts with users expressing regret for selling calls too early because the stock just kept going up, implying a massive 200% gain. Our AI-generated analysis shows robust revenue growth of over 35%. Analysts are overwhelmingly positive, upgrading AMD due to strong demand for its AI server chips, with some reports even saying 2026 chips are already selling out. And get this, insiders have been net buyers of almost 300,000 shares.
Ethan, it's clear AMD is riding the AI wave, and the insider buying is certainly a positive signal showing confidence. However, we have to look at the PE ratio. It's a staggering 115.69. That means investors are paying an enormous premium for future growth. The debt to equity is also very high at 6.36, and its beta is almost 2, indicating high volatility. While the future looks bright, a valuation like this leaves almost no room for error. Our previous ratings have been quite varied, with a stay away as recently as January 9th. This would be a significant upgrade.
It's definitely a growth stock, so a high PE is somewhat expected when demand for their chips is through the roof and future chips are selling out. The market is clearly anticipating continued explosive growth. I think the catalysts are strong enough to support a buy here, even with the high valuation.
For risk-tolerant investors, the growth story is compelling. I'll agree to buy on AMD, but it definitely comes with an asterisk for that PE and volatility.
Let's move on to Uber Technologies, Inc., Uber. We've got a user who thinks autonomous vehicle fears are overblown and Uber will thrive as a distributor. They highlight strong revenue growth of over 20%.
Well, the user sentiment largely disagrees with that bullish outlook, Ethan. Many comments argue that AV developers will simply launch their own apps, cutting Uber out entirely. The most upvoted comment asks, why would I ever use Uber app if Waymo has its own app and can just kill Uber by offering like $1 cheaper price? That's a huge competitive threat to their long-term moat. Plus, while the net profit margin is high, the operating margin is much lower, suggesting that current profitability might be fake due to tax reasons, as the user post itself hints at. And we're seeing net insider selling over the last 6 months.
So the core business profitability and long-term competitive advantage are concerns?
Absolutely. When the user base is questioning your fundamental business model against a future technology and your operating margins are weak, that high PE of 44 becomes a serious risk. For Uber, it's a clear stay away.
Agreed. Stay away for Uber. Finally, let's talk about IREN Limited, IREN. This is another one that has set social media ablaze. The post initially seemed negative, but users quickly clarified the original poster had huge losses from shorting IREN, which had actually surged by an estimated 1,000% in 7 months. It's up 27% just this new year. People are calling it a top AI pick after a Microsoft contract win and benefiting from Bitcoin rallies. Users are predicting it's headed to $100 plus. Our previous ratings have varied, with the last being stay away on January 1st.
Even the momentum is undeniable, and the AI catalysts are very exciting, potentially improving their revenue and profit margins significantly. The PE of 30.45 isn't outrageous for that kind of growth, and the beta of 4.26 screams massive upside if it continues. However, we cannot ignore the very thin net profit margin and, crucially, significant insider selling of 2 million shares, or over 14% of total insider holdings in the last 6 months. That's a serious caution flag, even with all the positive news.
It's a high-growth, high-volatility stock, Brooke. The insider selling is a concern, but the AI pivot with Microsoft, plus the Bitcoin tailwind, could really transform this company's financials going forward. I think it warrants a strong look for upside potential.
If they can execute on those AI contracts and boost profitability, absolutely. It's a high-risk, high-reward play. Given the strong user optimism and compelling future catalysts, I'd lean towards a buy here, but with extreme caution. This is an upgrade from our previous stay away due to the new AI catalyst.
Okay then, for IREN, let's go with buy.
So, to recap our hot leads for today, here are our top picks. Investigate as buy, JP Morgan Chase & Co., Advanced Micro Devices Inc., and IREN Limited. Investigate as cautious buy, none. Investigate as speculative gamble, Carvana Co.
All right, that's all the time we have for today's Daily Hunt.
Before we go, a quick but important reminder. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in, and we'll catch you tomorrow for another hunt for those multi-baggers.
Happy hunting!